Welcome to our April FD seminar update session. We're doing something a little bit different this session and are going to cover both tax and VAT in a joint update. For those who don't already know me, I'm Ross Bond, a VAT manager at Francis Clark, and I have Chris Rogers, a tax partner, with me to co-present. This session will briefly look at the key points arising from the spring budget before focusing on the main object of this session, the recent changes in HMRC's behaviour towards investigations and inquiries. Chris will go over the current landscape, what we're seeing on the ground, and I'll provide some perspective from a VAT angle with examples of some recent case law. I will then provide some practical tips and suggestions on how you can mitigate tax risk and advise on ways to communicate with HMRC, finishing with a couple of examples of how we have used such behaviours to drive outcomes from interactions with the revenue. Few surprises were included in the spring budget for businesses. The key announcements that are relevant are shown on this slide. From a VAT perspective, there is not a lot that came out of the spring budget other than the increase in VAT registration and deregistration thresholds to £90,000 and £88,000 respectively. Many have criticised the increase in the thresholds, stating that these do not go far enough, having not been raised since the 1st of April 2017, representing a minor £5,000 increase in 7 years. However, the reason for this is due to the Northern Ireland Protocol. The EU set a maximum threshold for VAT registration of €100,000 in EU member states, which Northern Ireland are bound by. Therefore, if the UK were to increase the thresholds beyond this limit, it would create the need for two VAT regimes in Britain, one for Northern Ireland and another for the rest of Britain, something HMRC are keen to avoid.
And on the corporate tax side, we had, in the autumn statement, full expensing and the 50% first year allowances were extended on a permanent basis. The Chancellor announced at the spring budget that full expensing would be extended to assets used in leasing when fiscal conditions allow. What that means in practice, I'm not sure we'll ever actually see. I think the amendment itself is welcome, assuming it sees a light of day. It would support the leasing sector and groups that, have an asset holding company and lease to their trading subsidiaries from a commercial risk perspective. It'll be interesting to see what the draft legislation looks like if it comes through, and whether any types of leasing are actually excluded from the rules. We've also seen the reduction in the Class 1 national insurance contributions for employees, so cut down to 8% from the 6th of April 2024. Whilst this is welcome news, in reality it's somewhat tempered by fiscal drag, which sees a number of people paying higher and increased rates of tax. There are also some significant announcements that relate specifically to the creative industry sector, which gives sort of £1 billion of tax relief over the next 5 years. I wouldn't propose to go into those in detail here, but it's a clear signal that the government wants to continue supporting the arts, and reliefs aimed at businesses operating and producing UK films, theatrical productions, and museum and galleries, exhibitions, etc. So actually, overall, the spring budget didn't have a huge amount in it for businesses to cheer about, but this is not entirely unexpected given that a general election is fast approaching. So next we turn to HMRC compliance activity. Just to set the scene, we are seeing increased amounts of compliance activity across the full range of taxes. I'm going to go into some of the reasons for that and some of the statistics. So the tax gap, with public sector debt increasing and continuing to grow, there is increased pressure on HMRC to deliver greater yield and minimise the tax gap. HMRC defines the tax gap as the difference between the theoretical taxes that they should be able to collect and what they actually collect in practice. The tax gap can arise for a number of reasons. Some taxpayers make mistakes, others choose not to comply. It can be because of they cannot pay because of insolvency. In other cases, there are different interpretations of rules and so on. The key observations from looking at this slide is that the total tax gap, it stands at almost 36 billion pounds for 21-22. that's out of a total theoretical tax take of £739 billion, so roughly 5% in tax gap. VAT is making up around £7.6 billion of that number, so 21%. Corporation tax is actually a bigger number at 10.6 billion, almost 30% of the tax gap. But I think more interestingly for the people in the room is that, particularly when it comes to corporation tax, £9.9 billion of that tax gap relates to small and mid-sized businesses, or is perceived to relate to small and mid-sized businesses. Now, the revenue describe large businesses as anything with a turnover of £200 million or more. So it's really the businesses in that sort of sector up to that point that give rise to a significant proportion, of the tax gaps. So almost 10 billion out of 10.6 on corporation tax cap on the gap. So this really is one of the reasons that we are seeing, increased rates of inquiry and a lot more scrutiny from the revenue over the last couple of years. Only yesterday we had Rachel Reeves in the press saying that Labour are aiming to tackle the tax gap. I think she's committed potentially to spending £555 million on attracting and adding additional officers into the HMRC pool with a view to getting, closing the tax gap by £5 billion by the end of the next Parliament. So that just sort of shows you the direction of travel, and I think we can expect, more scrutiny and more HMRC activity generally going forwards. So turning to the next slide, this shows you really the share of the tax gap over the last 5 years. I think interestingly, if you look at the orange bars, those represent the corporation tax share of the gap. We can see actually corporation tax gap has, as a proportion of the total tax gap, has grown from 18% to 30% over the last 5 years. So heading in the wrong direction from an HMRC perspective. If you look at some of the others, VAT has actually dropped from 34% down to 21%. So I think it's interesting to see that sort of movement. I don't know whether some of that might be down to things like making tax digital for VAT in terms of some of that drop. It's a reasonable movement. HMRC estimates that the yield from its sort of compliance activities was 22-23 was £34 billion, up 10% compared with 21-22. But this is still £2 billion below its target. And if you, again, harping back to what Rachel Reeves said yesterday, we're looking at potentially trying to raise a further £5 billion a year on top of that figure. So you can see that there is room for improvement, and I'd expect further intervention from HMRC over the next few years. But this does require, I think, a significant investment in the revenue in terms of its people and its technology in order to do so. So what does this mean in practice? So similar message. We're going to see, or we are seeing, a significant increase in HMRC compliance activity. This is after a decade of sort of minimal inquiry, really, and so we're seeing much more inquiry activity, more investigations, nudge letters, project-based inquiries across a range of taxes, not just R&D tax credits. So turning to nudge letters, for example, we see those being sent out en masse to deal with specific issues or perceived issues. A good example is we've seen nudge letters on super deduction, now called full expensing for capital allowances purposes, and they've sent out standardized letters to taxpayers en masse where they've identified some risks. On a volume-based approach, those can be, looking at super deduction is a good example, because we've got a business that looks like it hires assets and so therefore it doesn't benefit from the relief, or there's a question mark over whether all the additions that you've put on your computation are brand new and therefore qualifying. So there's a lot of that kind of activity, and I think we'll see more of that across the full range of taxes. Especially say the revenue are also taking a data-driven approach to inquiry activity. We'll come on to that in a bit more detail on the next slide, which looks at what's called HMRC Connect. I think the main message here is that what we're seeing here in practice is a real challenge with HMRC's approach. Now, some of this is down to having caseworkers who do not have enough experience to properly run an inquiry, and there's a sort of lack of engagement. So, for example, we've had issues where caseworkers might have 2 to 10 weeks of training, don't have very much oversight from senior officers, and actually, on the inquiry letter, there's no named officer, and so you're effectively dealing with a mailbox, no phone number, no one to contact, and so things just take much longer and are more difficult to manage. And inquiries, as a result, take much more time from our perspective, from a client's perspective. Frankly, it's a letter takes much longer to put together than a phone call, and a lot can be dealt with on a phone call typically. So in many cases, we're also seeing that because of that disconnect and the junior nature of the team at the revenue side, we're seeing situations where we end up actually having to work the inquiry for them, almost lead them through it. And that just leads to increased costs from a professional fee perspective, but also diverts your client's perspective attention away from their day-to-day business. It's therefore really important that clients take steps to proactively manage tax risk across their businesses and to mitigate HMRC inquiry risk as far as possible. We'll come on to some of this later. So HMRC Connect, as I mentioned earlier, is their data matching and risking system. So I think one step behind AI, but heading in that direction. It's aimed at targeting taxpayers and selecting them for investigation. The system picks up 55 billion items of taxpayer data, and that can come from several sources. So just to give you some examples, bank accounts, property websites, land registry, flight sales and information, Google Street View, council tax records, etc. And so it's very powerful in that sense. It allows them to apply a volume approach across a range of taxpayers. So when the system identifies anomalies between what a business's earnings are and its outgoings and so on, it effectively flags that case or those cases for potential investigation. The downside of this is that because of the wide range of sources of information, inevitably there is data that will either be invalid or misinterpreted, and so we can lead to innocent taxpayers being selected for investigation, and that's obviously can be quite painful because it just brings additional costs, and as I mentioned earlier, inquiries are taking longer to close down. Turning to R&D inquiries, 1 out of every 5 R&D claims is being inquired into by HMRC. So that's 18,000 out of 90,000 claims made annually. HMRC's approach creates the perception really that almost all claims inquired into will be rejected. We've got caseworkers here with significant workloads. I think there's circa 400 caseworkers in the R&D credits team or in the ISBC team that are targeting R&D claims, working around 45 inquiries each based on the numbers mentioned above. It therefore means that inquiries take a huge amount of time to bring to a conclusion, and we're seeing claims being taken through to appeals, and therefore because of the volume, the appeals, the whole HMRC appeals system is clogged up with disputed R&D claims. The ICAW and CIOT are collaborating on next steps, and we'll be releasing more on this as and when information comes through. It very much an R&D prevention is definitely better than the cure. It's important that businesses take careful consideration of their R&D projects by the competent professionals in the business as to whether the projects are qualifying R&D for tax credits. It is vitally important that projects are carefully detailed and explained in both the R&D claim report, but also the additional information form that was introduced from August last year to ensure that we're including sufficient information around what the project's involved and why they're qualifying R&D and what the nature of the expenditure was and why it qualifies. I think I'd urge clients really not to rush their claims. You've got 2 years from the end of an accounting period in which to make a claim, and I think given some of the uncertainty that we're seeing and some of the difficulties that we see with HMRC's approach, I think actually using that claim window to your full advantage, 2 years from the end of the accounting period, is something that's sensible to do.
Chris talked about the increase in HMRC compliance activity, the variety of information available to the revenue, and campaigns to target particular areas of non-compliance. Following the removal of HMRC's discretion to not charge interest on underpaid VAT, we are also starting to see an increase in VAT assessments being raised as part of those inquiries. And this is perhaps not surprising given the high interest rates. The changes in HMRC staff is not limited to tax, but we're also seeing this in respect to the revenue VAT officers. This can result in unexpected outcomes from fairly straightforward queries due to a lack of experience or training. There is, of course, a chance that such a decision could be overturned following an independent review. And there are still good quality experienced officers at HMRC, perhaps just not as much as there used to be, which means we're seeing less and less success in satisfactory independent reviews. Instead, HMRC seem much keener on defending a case at tribunal should a taxpayer wish to take the dispute further, although this can be a costly exercise. And as we will see on the next slide, it isn't just cases with significant VAT amounts at stake, but also where the values involved are fairly low. In certain situations, it may be that a compromise can be achieved through mediation with HMRC via the alternative dispute resolution option, an option any of our advisors would be happy to assist with if it's available to the business. I've selected a handful of tribunal cases on this slide, which demonstrate the trends we are seeing, all of which relate to decisions released in 2023 or 24. The first one, Free Shires Trailers Limited, relates to a business's input VAT claim of £22,500 on the purchase of 2 Land Rover Discovery vehicles. Everyone was happy that these were to be considered commercial vehicles for VAT purposes on purchase, but shortly afterwards, seats were installed behind the driver's seat and the blacked out windows were cleared. HMRC were arguing that this made the vehicles cars for VAT purposes, and they did win their technical argument. This would mean that a deemed supply takes place and VAT would be due on those vehicles as if they had been sold. However, what HMRC failed to consider was whether the cars would have fallen within the definition of qualifying cars if they had originally been acquired in that same state following the conversion works. This is what the tribunal found was the case, particularly as they were used wholly for business purposes and kept at the business premises. And as a result, HMRC may have won their technical argument, but they lost the case overall, and no VAT was due despite the conversion works. This is an example of HMRC getting hung up on a technical point without following that through to conclusion, even willing to defend that at tribunal. The Real Read Limited case involved a business that had been applying the same VAT treatment to its suppliers for 30 years. HMRC had visited that business on multiple occasions, but there had also been changes to the business in that time, and HMRC, whilst carrying out routine inquiries, they never carried out an in-depth investigation into the VAT treatment of the suppliers in question. The taxpayer tried to rely on the legitimate expectation argument, as HMRC had visited the business many times and had never told them that the VAT treatment was wrong, but they failed in their efforts. This allowed HMRC to assess for underpaid VAT going back 4 years, although it was noted that had the business written to HMRC for non-statutory clearance and HMRC agreed with their treatment, this could have created a legitimate expectation, allowing a change of treatment to be applied from a current date, but may have protected the business from a 4-year backdated assessment. Additionally, the point was made clear that it would have been expected that a reasonable taxpayer would have reviewed the treatment regularly and checked this with an advisor. Failing to do so was considered careless, highlighting the importance of proactive risk reviews. This is exactly what Airline Placement Limited did. However, they failed to place all their cards on the table, so to speak, leaving out a key point which was highlighted by their advisor as being the main risk to the business. By leaving this point out of their clearance application, the court ruled they were not able to rely on the creation of legitimate expectation, losing the case and demonstrating that it's not just important to seek clarity from HMRC, where the guidance and law is unclear and amounts at stake are significant, but also to ensure a full disclosure of facts. The final case on the slide here is purely to demonstrate that HMRC have no political agenda and will go after anyone where they feel there is non-compliance. So even if there is a perception that the sector or area your business operates in may be safe from scrutiny, this evidently is not the case, as proved by the NHS Foundation Trust case. HMRC actually lost this case on a pretty straightforward technical point and tried to drag the taxpayer through the mud rather than losing gracefully, and it makes for a rather embarrassing read if you are looking for some bedtime reading. So now we've seen the pattern of behaviour from HMRC in recent times, leading to an increase in compliance activity, but what can you do to protect the business? So there are several ways you can help to reduce your risk of a long, drawn-out inquiry, together with the associated costs involved, as well as the stress and time diverted from running your business. And businesses at all levels need to be more proactive in how they manage their tax affairs and associated risks. For larger businesses, this should include detailed tax risk matrices and policies. Smaller businesses may want to consider discrete health checks or reviews to manage specific areas such as employment taxes. Use of the white space narrative disclosure to provide further information or clarification of transactions on the return will assist in dispelling misinterpretation or misjudgment of information, and this should also help to minimize the inquiry window to 12 months from filing or 12 months from the tax return deadline for companies that are not small. Disclosure should also help to evidence reasonable care and therefore the risk of penalties being charged as part of the inquiry. It would also be reasonable to consider obtaining professional fees insurance to protect against the substantial costs of defending an inquiry by HMRC and possible litigation fees. Some specific practical points for VAT purposes are on the slide here. So when carrying out an investigation, HMRC will follow a structured review designed to identify key risk areas of non-compliance and therefore would be a good place to start when considering VAT risk to your own business. This would include income received by the business where VAT is not charged and paid at 20%. So the business should identify such income and be able to justify why VAT is not due at 20% on the amounts received. When looking at VAT claimed on expenditure, HMRC will look at the largest VAT value invoices, and whilst it's important to be able to support VAT recovery on all supplies where VAT is being claimed, it would be sensible to regularly check the larger values as part of a risk-based approach to VAT return reviews. Other places HMRC typically look would be the business bank accounts and signed accounts to ensure these reflect the income and expenditure shown on the VAT returns. Invoices, these should be checked to identify any breaks in sales invoice numbering. This can help avoid missing income on the VAT returns. And of course, ensuring purchase invoices contain all the necessary information required of a valid VAT invoice for VAT recovery purposes. HMRC will always ask for a report of outstanding debtors and creditors over 6 months, so check your bad debt claims. And as demonstrated in the Real Read case, it's important to review any new income streams or changes to the business, as even small subtle changes can impact the VAT treatment of supplies. Chris talked earlier about nudge campaigns and task forces set up to look at specific areas, and this is something we see in VAT too. And we're often involved in discussions with HMRC on such campaigns. And whilst we're all generalist VAT advisors, we do have specialisms in a variety of sectors. So it might be worth a chat with your usual contact to see if there are any areas that you should be included in your tax risk register reviews, or potentially opportunities to minimize VAT leakage or improve VAT recovery for the business. So the airline placement case was a good example that it's not just important to communicate with HMRC in areas of risk, but also how you communicate is crucially important. If responding to HMRC in connection with a tax inquiry, first and foremost, ensure the inquiry is valid. There are procedures and processes HMRC must follow, and if any of these are not adhered to, the inquiry may not be valid. We are blessed with a number of ex-HMRC staff who know these processes well and can help ensure the correct steps are followed from the outset, an example of which is included on the next slide. Respond in a timely manner, even if this is to request an extension to the deadline already set. The last thing you want is to have to rely on HMRC's discretion because you've missed a deadline. And many of the penalties are behaviour-based, therefore responding in a timely manner, being open and providing access to records and helping HMRC officers can reduce any potential penalties that may become due as a result of that inquiry. Given the reduction in quality experienced officers, building a network of useful contacts is invaluable, and a dispute can become very difficult if the communication breaks down and the officer begins digging their heels in, something you want to avoid wherever possible. It is important to ensure any arguments provided are well-founded and stand up to scrutiny. This would require consideration of counter-arguments and following through the outcomes based on various scenarios to ensure all perspectives have been covered off. This may involve seeking a second opinion or expert advice, such as consulting tax counsel in certain situations, dependent on the values involved, of course, and costs in obtaining such expertise. Finally, it's not just important to consider these communication tips after an inquiry has been opened, but also if making a disclosure or a claim. Otherwise, you risk leaving yourself open to HMRC forming their own opinion, resulting in a much more difficult task of trying to change that opinion, rather than being proactive and doing the groundwork for them, setting them up to either simply agree with your position or the more difficult task of them trying to identify flaws in your own well-founded technical argument. Finally, a couple of examples of cases we've been involved in where the outcome has been driven by the manner in which we've communicated with HMRC. The first case involved a £50,000 request for input VAT on expenditure not previously claimed. HMRC initially refused the claim on a technical point. We discussed the dispute with one of our contacts at HMRC, using past experience within the team, report built with the officer in cases where we had been successful in the past, and using well-prepared technical arguments, we were able to have a fair debate. Finally, in an effort to conclude that debate, we offered to concede on a very minor technical point, one which we still do not agree with, but at the cost of only £2,000 in an output tax charge, we were able to sway HMRC, who then rolled over and allowed the full £50,000 input VAT claim. So the compromise paid off, and it avoided the case dragging on, or worse, leaving us to have to go to tribunal and appeal the initial decision. The second case concerned a £230,000 overclaim of import VAT. After identifying the duplicated claim as part of a routine VAT return review, the error was notified to HMRC, as expected. However, HMRC took too long to assess the overclaimed import VAT, and so when the assessment was eventually raised, we challenged this based on the assessment falling out of time. At first, HMRC did not budge on their position, and so we requested an independent review, although HMRC stated that such a review was not available, arguing that our initial discussions already constituted a review. And this left us with the only route to challenge the decision further via a costly tribunal. So we did actually file a tribunal appeal, but followed that application up with a discussion with the officer in order to pose the questions which were likely to be asked at tribunal to them directly. The HMRC officer liaised with their tax counsel and, following those discussions, decided to withdraw the assessment, saving the taxpayer a significant amount, not just in the assessment, but also in further litigation costs.
So in summary, it's fair to say that we've seen a significant increase in HMRC and compliance activity in various forms that we've mentioned in terms of nudge letters, formal inquiry letters, etc. That's across a full range of taxes, so not just corporation tax and VAT. Sort of harping back to the tax gap we mentioned earlier, I think it's reasonable to expect that we'll see more inquiry activities, particularly the small and mid-sized business ends of the group. That's because it actually appears that the revenue are doing a reasonable job at closing the tax gap for larger businesses. So I think it's important to know. I think the other point here is that often inquiries are taking longer, as we've mentioned. They're taking longer to conclude. You're not always getting to a reasonable conclusion in our eyes. And it makes them more expensive and time-consuming from your perspective. Prevention is absolutely better than the cure. we can, the important things here to know are making sure that you're placing proper disclosure on tax returns, proactively trying to manage your tax risk in terms of tax risk matrices that Ross mentioned, desktop reviews, health checks of specific areas to make sure that you're managing the key risk areas for your business, which will obviously differ depending on the sector that you're working in and on the scale of your business. So I think, in summary, tax risk management should be higher on the agenda for SMEs, partly to minimise your risk of HMRC inquiry and to make sure you're getting your taxes right. But there are other good governance reasons for that. And also, it's worth noting that if you end up in a future transaction, having good processes and controls around tax will help you in terms of getting through a due diligence process more smoothly. If anyone's got any specific questions on any of the topics we've discussed, feel free to speak to one of us or contact your user contact within FTSE.